Good morning, everyone. Thanks for joining us today. Welcome to the Babylon Pump and Power FY24 Results Investor Conference Call. All attendees are now in listen-only mode. And on the call today, we've got Babylon Pump and Power MD and CEO, Michael Shelby. I'll pass you across in a moment to Michael to kick off our discussion of the company's full-year results. Today, we'll have a presentation from Michael, followed by an opportunity for Q&A. If you would like to ask a question during the call, please type it into the Q&A panel within the Zoom app. So to kick things off, I'll hand over now to Babylon Pump and Power MD and CEO, Michael Shelby. Go ahead, Michael.
Thanks, Tim, and thank you, everyone, for your time and attendance. I'll get straight into it. Let me click through my disclaimer there, and I'll start with a brief introduction because hopefully there's a few people that might not be intimately familiar with us. So about Babylon Pump and Power, we're a small, growing resource services company. We specialize in two areas, rental and maintenance. The rental side of our business specializes in water management, and that's everything from test pumping, which is early days in a mine site development, through to the disposal of excess water on the back end of a project. We have touch points in between those two endpoints with rental equipment and services that we provide in there. We also provide power generation, temporary portable power generation. We provide traditional diesel-powered units. And in this past year, we've also introduced hybrid power into our fleet, where we have a combination of solar and battery power to complement the diesel. It's something that we have seen an opportunity in the market on the rental side of the business to be able to rent this equipment, and we're trying to do what we can to grow that, to give clients the opportunity to reduce their carbon output through using the proper rental gear. So that's the rental segment. On the maintenance segment, we specialize in rebuilding client equipment. We specialize in large diesel engines. That is the bulk of the business, and we do have some contracts in place with some of the major guys where we rebuild their ancillary equipment, the pumps and the diesel generators, similar to what we have in our fleet. We feel like we're experts at maintaining our fleet. We have maintenance capabilities for our own use, so we have the opportunity to offer that to clients and make money in that segment as well. So that's how we're positioned in the two segments. We'll jump straight into the FY24 financial highlights. It was a year that I'm very proud of, and I feel like we've kind of turned a corner. We've grown our revenue to nearly 42 million. That's up 28% over last year, and we're running just under 30% year-over-year growth since listing in 2018. Our EBITDA company-wide is up 118% from our underlying EBITDA last year. Past couple of years, we've had steady growth there, and we're really proud of where we're going. And very proud this year, we've turned an initial net profit, $500,000. We feel like we've turned the corner. We've kind of planted the flag, and it's onwards and upwards from there. And that's our maiden impact. And we feel like we have opportunities and strategies to continue to grow that year over year. We have good operating cash flow. That operating cash flow is quickly put back to work. And we try to take that cash and put it back into the business, whether it be buying assets and capabilities to grow the rental side of the fleet, or we have a little bit of extra to pay down some debt that we've had over the past couple of years. We have paid off our deferred consideration from previous acquisitions over the past 24 months, and with that, we paid roughly $2.5 million last year, and that's free cash for FY25 that we will be able to reinvest into organic growth going forward. So we feel like we have a plan there that this cash will be put to good use. Further information on the snapshot for the financial year. The P&L is as kind of I stated. We've had revenue growth, then outsized EBITDA growth, and some impact growth as well. But what I really want to draw attention to is the right side of the sheet, the balance sheet, where we've been able to grow the maintenance side of the business, which does have a high working capital component and a high inventory component. We've been able to grow that and improve the profits last year, all while reducing our inventories. We feel like this is a big benefit there. We've freed up some cash by having parts on the shelf turn to cash. more efficient planning, more efficient works on our end. We're able to deliver to clients, have happy clients, we're delivering on time, but also reduce our inventory, freeing up some cash to put to work throughout the business. Also wanted to highlight that we've paid off the deferred consideration from FY23, and that's now down at zero. Everything is fully paid, and that's cash that we can put to work. We're no longer paying interest on that, and it's free cash flow that can go to buy other assets. We've also reduced our borrowings year over year, a slight amount, but we've reduced our borrowings, and we have capacity within our asset financing facilities where we will, likely draw that back down. But it's given us the opportunity to take a breath and really figure out the right fleet mix going forward. And we have strategies in place to grow our fleet mix, grow our hybrid capabilities, and grow our specialty pumping capabilities where we're getting the biggest bang for our buck. Wanted to show where our growth comes from. FY23, we had a good result, but a better result in 24, and that is the maintenance segment has grown significantly, EBITDA, and the rental segment has grown at a slightly lower rate, but it's grown as well. So we've had growth against both segments, and all the while we've kept the corporate costs and the overheads relatively stable. We feel like that it's where it's going to be going forward, and we have a good base to grow from here. Now, we've delivered record EBITDA, operating cash flow, and NPAT. Again, made an NPAT. We've paid off our deferred consideration, to free up some cash. Now, how do we do that? That's growing the rental business and the cash flow that comes from the rental business. We've introduced new assets, the passive evaporation technology that I've put forth in some other announcements, where we're able to bring something new to the market, which consumes less power, has less residual risk to the client on a rental basis. And we've had a good uptake there. We feel like that's an opportunity for us to grow in that water management a specific portion. We also have brought hybrid power units to the business, to the rental market. There are a handful of people out there that like to sell these units, but on the rental market, the options are fairly limited. And our client base are major resource companies that need to report and will need to reduce their carbon output. And we feel like we're giving them an option going forward to be able to reliably reduce their carbon output with someone like us that they do business with, that we know this equipment, and just trying to give them more tools in their toolbox. Again, we've had profitability improvement across all the segments. The maintenance segment has improved through more efficient works, repeatable works, same big client base that is able to send more work our way as we continue to mature as a business, and they trust us to continually perform. And utilization within the rental side has improved, and that's really driven the growth there. We've had a little bit of CapEx, and I'll get into that a little bit later on, but we've had kind of reduced CapEx this past FY24 year compared to going forward. Some other efficiencies that we've had is last year we finally consolidated several remote workshops where we're operating in one head office facility in Perth. We have a maintenance business in Mackay, but we're able to get rid of some of these legacy small workshops, be able to work efficiently, have everyone in one spot, and reduce our overall lease commitments as well. We have a long-term plan where we're at with a purpose-built building for us with a long-term lease. We're very comfortable in it, and it's really starting to pay dividends for us. The years of planning that went into developing that with our landlord to go forward. We've improved our balance sheet, reduced our borrowings, reduction in inventory, turned that to cash, and then subsequent to the financial year, NAB increased our invoice finance facility $1 million to a total of 5.1 mil. That's small. It helps. Every little bit helps. NAB has been very supportive of us over the years, and be able to provide that little bit of extra as our turnover is going up, knowing that we have a very stable counterparty list. Our largest clients are the BHPs, Newmont, Glencore, Rio, FMG. So it's very very stable and very easy for the bank to be able to tick the box and give us a little bit of extra invoice finance where required. The rental segment, as I said, revenue up 20%, EBITDA up 31%. We feel like we're at a spot with the rental segment. Our overheads and our base is there. It's grounded. We can grow going forward without additional significant headcount. If we can just grow our asset base and maintain high utilization, the results will be there. Our rental growth has been driven predominantly in the gold and iron ore sectors with our clients, with our existing clients. Our clients have big wallets. They spend big on rental gear. So for us to go in, get a foot in the door, be that trusted provider, that specialist provider, what we provide is not always off the shelf. It's sometimes a very unique offering. The clients trust us. They're able to give us more and more opportunities. So we're getting growth within existing clients, which is the most efficient way to grow for us. As I said, lower CapEx spend in FY24 because we like to assemble our assets ourselves. We feel like we can do it cost effectively because we have the workshops that do the maintenance work. We have that capability in-house to assemble what we need. We can also assemble it to our standard. We tend to have a higher standard because we want a 10-year plus life for our equipment versus just going to an OEM and purchasing a piece of equipment. A lot of that equipment is built to a price point. We build to a kind of a lifetime point that we want. And we can do it more efficiently, generally lower spend, but it does take time. So we feel like going forward, there will be a mixture. We'll use some of our asset financing available with the banks to be able to go and purchase OEM equipment, but we'll also continue to build our own assets to make sure that we have a robust fleet going forward. We don't have the luxury of time to assemble everything we want to. So it's a matter of trying to get that mix right. We have a very experienced operations team with decades in the pumping business and in the power generation business to be able to make sure that we get that mix right and go forward. And, as always, we're always on the lookout for whether it be acquisitions or assets, bulk asset acquisitions. The specialty pumping market is still a bit fragmented, and we're always trying to look for those opportunities and evaluating those opportunities where we can grow our capabilities, grow our touch points with our client, and try to do it in a very cost-effective manner. We were successful in the past couple of years of bedding down a test pumping business and a small pump rental business. We did that without significant shareholder dilution because we're able to use bank debt and deferred consideration to make those acquisitions happen. We like that model, but that model works for smaller acquisitions. So we'll continue to go down that path where we can to be able to incrementally take the next bite and grow from there. We're always on the lookout though for something. If there's something transformational, if there's something large, we're always open to the opportunities, but we feel like we have a good track record of taking the small bites to get us where we are now. Maintenance segment, again, revenue up 32%, but EBITDA up tremendously at 137%. And this really something I've repeated, for a year now. It's initiatives we put in 2 years ago to really have a flat structure within the maintenance segment, and then also to really focus on the repeat engine building programs for key clients. We major household names give us engine rebuilding work. And we're now to the point where instead of doing the bit pieces where we might do one engine rebuild here, one engine rebuild there, we're getting programs where there might be 5 trucks or 15 trucks or 4 diggers where we're getting those engines and it's flowing through our workshops in an efficient manner, allows us to work better, work more, quickly and efficiently, clients happy, and then also with that repeat work, we can make more money with better margins. Both facilities in Mackay and in Perth have been very busy the past year. Both have increased their throughput, and both have increased their profitability, which is great that the same initiatives are in place and bearing fruit on 2 different sides of the continent. trying to minimize our working capital in the maintenance segment. It is a working capital intensive business because we have to go buy parts and do machining and that sort of stuff that goes back into rebuilding an engine that might not go back to the client for 6 to 8 weeks. So at any time we have a significant amount of cash in play to buy parts and also going to our sub suppliers. Strategic initiatives this year to try to reduce that. Getting rid of excess inventory, trying to rationalize the type of work we're doing and focus on specific lines of work with engines and repeat business, so we don't have to carry too much what I would call sometimes random stuff to satisfy everyone. We've matured to a point in the business. We're not just taking work. We're trying to go and target work, and that's really paid off the past year and shown through in our financial results. On the maintenance side of the business, again, blue chip client base, and it is significantly iron ore and coal sector over in Queensland. Now, from a long-term growth perspectives, we want to grow our rental business, our water management capabilities, and with that comes the power generation, because a lot of the power generation we do helps power the pumps. But mines are going bigger and going deeper, and that means more water problems. And it's just being able to position ourselves as the specialty type water services, water management, water services company to address these needs. Photo on the right. You're not going to call your local rental company and just go to the branch and pick up some pumps and go put it in there. That requires high horsepower, high head pumps that are really really specialized and not off the shelf. We feel like that there'll be a continuing need and continuing growing need for these type pumps and these services as the resource sector continues to mature in Australia. There'll always be new mines that come up, but probably not as many. So we'll have existing mines that'll go deeper where they have the ore bodies and go deeper and get larger to try to maximize their profits. We're there to help. And the great thing is the pump that you need today is not the pump that you need 6 months from now, which really pushes a lot of the mid and smaller guys really towards renting, because unless you've got an unending amount of capex available, you'll be buying pumps constantly. So that's where someone like us comes in that has a robust fleet where we can provide pumps for the first 6 to 8 months of a project, and then as the pit goes deeper, it takes different types of pumps to pump the water out of a deeper pit, so we can replace those pumps and really grow with the client and make sure that we work hand in hand to minimize the impact of water on their activities. Outlook going forward, like we said, since relisting in 2018, we've had a great, just under 30% year-over-year revenue growth. We've been able to improve the balance sheet. We have profitability across both segments, and even within the segments, the multiple workshops in the segments. So we're happy with that. We've delivered that maiden impact. We feel like that has now just gotten us back to the starting bench, and we want to grow from there. But we feel like we have the people in place, the structure in place to really go from where we were a very small company back in FY19 with only 11 mil turnover to close to 42 this past year. That's been tremendous growth, and it's been sometimes a bit of a wild ride, but we've grown, we've learned, and we've improved, and that's the main thing, is we have the ability to continue to improve from here. We provide critical services. It's innovative. We're trying to bring new products to the rental market where we can help clients reduce their carbon output and do things better, whether it be burning less diesel, using less power, but still accomplishing the goal with specialized rental equipment. That's where we want to be, and that's where we want to position ourselves. Bit of a corporate snapshot. We have, the key areas there. Top 20 holds about 50%, and the board management we hold just under 8%. We have a very an invested group. The executive team working with me include our one of our largest shareholders by acquisition, and then also it's guys that I've worked with for close to a decade. So we have a good working relationship. They have shown the faith to come and join Babylon in years past with me and continue with the journey. And we feel like that we are now really positioned to continue to grow from here, and with a good base that we've built so far. And that's the obligatory shot of the board. And yeah, that's it from me at the moment. And I'm happy to take questions and go from here.
Excellent, Michael. Thank you for the presentation. And thank you to our attendees for some great questions which have been coming in on the through the Q&A panel. So for anyone who has questions for Michael, please pop them in that way and we'll hop straight into them. So first question here, just delving into the rental side, question's been asked about level of interest in the hybrid generators compared to the traditional diesel generators. It's investors asking, do you expect a strong uptake for the hybrid generator by existing clients in FY25?
It's been a bit harder, quite frankly, it's been a bit harder than I expected, because you see the corporate communications coming out from our clients, and everybody's talking the right game. But when you go and you approach them and say, here, we have an alternative, it's taken more work. But we have learned from the process. We feel like we know what they're going to ask, and we've been able to to successfully put multiple units out at a major gold miner. So a bit of a learning curve for us, a bit of a learning curve for the clients. And so we now know what information we need, and we have case history now. We can give actual results of units that we own. So we feel like the uptake will increase from here. It's not a passing fad, but we're in a very conservative business, and clients all want to make sure that if they're putting their name against something, or if they're making a decision, they don't want the power to go out. So we've got to build that confidence, and I think we've done that. We've got a story we can spread now. So I feel like it will be a bit of an accelerated growth. And then also the product offerings are getting better as well. We're not tied to one supplier. We have multiple suppliers that we're talking to. So we feel like every month that passes, there's better products or learnings, and that also gives us more ammunition to go speak to clients. So we feel like, yes, diesel's here to stay. In my lifetime, we're always going to burn diesel, and we're always going to burn diesel in remote generators. But we feel like the cracks have opened to allow the hybrid units in, and we feel like that there will be a good flow of information, a good flow of product out there. There's a lot of generators on site, so there's a lot of opportunity just to replace existing diesel generators with hybrid units, and you can make a significant amount of return on your investment just by doing a small portion of that.
Yep, it's a trend to watch. Good stuff. Another rental segment question, but which is also has some relevance to the maintenance side. Just on sort of the concept of commodity price decline, specifically with iron ore coming under pressure in recent months. Has that meant that Babylon's seen softening demand from in the rental segment, or is it more a case that you see customers working their assets harder, to the extent that dewatering is you can't not have it? So
right. Well, dewatering power generation, you have to have it. It's absolutely critical. We see opportunities as clients are looking to potentially sharpen what they do and rent, and instead of capex. So we feel like in the medium term, people may not be buying equipment, might be putting some capex on hold, which means they have to rent, which is great. We're happy to do that, but it's critical. There's always going to be opportunities there for the rental business, and especially when it's unknown, people will kind of defer to renting as well. On the maintenance side of the business, we do see people sweating assets harder, which means rebuild. And instead of making, again, big capex plays where you're going to go buy new equipment and really expand there, just being able to rebuild equipment, what you have, get a few more years life out of it, that sort of thing. We're seeing an opportunity there. And again, generally, we are dealing with the big end of town. So even if the commodity prices pull back, like I said, our largest client would be BHP. They're not going anywhere. So we'll continue. There'll be some efficiencies they'll seek and that sort of thing. But we feel like just as a client and as as a client with a big purse, there's always going to be opportunities.
Yeah. Thanks, Michael. Still on the rental segment, do you want to comment on how you're seeing utilization levels tracking across the book and sort of what's optimal for Babylon in that regard? Mm.
Yeah, we kind of have a rule of thumb that when you start to get over 75% utilization, you want to make sure that you have more assets coming in. It's either means a high demand from clients, or you may be in a problem because your gear's out working hard. You need to have some backups to keep clients happy. We As a growing business, it's kind of a roller coaster because we'll have very high utilization. We may go approach 80%, then we will build or buy some more assets, then it'll drop back down, back under 70. So it's that constant growth. But we are growing our rentable asset base, and that utilization is fluctuating, but we see a kind of the right trend, upward to the right. And off the top of my head, we report this monthly into the board. We're traveling at just over 70% total utilization for our assets, and that's a mixture of everything from power generation to pumping. So we feel like we've got a good mix, and as long as we can keep it up there and continue to add a few assets along the way, we'll be growing both our capability and our earnings.
Yep. And I guess following from that, can you comment further on what type of rental assets are showing you the most demand from your clients at the moment? And I guess how that might feed into how you're looking to reinvest your free cash flow in FY25?
Well, we have quite simply all of our hybrid units are out and on hire. So we need to increase the fleet there, and again, working with multiple suppliers to try to figure out what's the best path forward, as don't have all of our eggs in one basket with one supplier there. But then beyond that, it's the big stock specialty pumping. It's the big horsepower. It's the guys that need to move a lot of water at a high head. So we're talking the 700,000, 1,200 horsepower type pumps. They're big dollars, and not everybody can go capex these. And if you go buy them from your normal OEM, you might have a 16 to 30 week wait, depending on the state of the world and the supply chain. So as we're able to assemble these and able to acquire these type units and put them in our fleet, we're getting them out on hire. So that sets us apart. Having that type gear, you're not going to go to your local rental corner store and do that. We're talking gear that weighs 15 tons. So that's where we want to be, in that specialty rental, and we're going to continue to grow there. We will have a lot of the, what I'd say, me too, small stuff. You need to have it, you need to keep people happy, but that's not our focus. I think the company's growth will be driven by the specialty rental.
Yeah, sounds great. And looking to the commodity mix client-wise, with rental growth having been predominantly from gold and iron ore up to this point, do you see much scope to expand into other commodities?
Yeah, well, we've had bits and pieces elsewhere. We've had a bit of work in the lithium market, and we do work for Nickel West as well, and nickel. So we have a bit of a spread, but it is predominantly gold and iron ore, and we want to go where the opportunity is. And right now, we are seeing a lot of opportunity in the gold, and kind of taking a step down to the mid-tier players, which we feel like that's great. They're screaming for service and support and growth. So we're trying to make sure that we can manage that and do what we can there. So we really kind of want to focus there. Our rental is fairly contained to WA right now. We don't have much elsewhere. We've done a bit in the Northern Territory, some service work up there, but it'll be predominantly the mix. We feel like there's a good mix here, and we do a bit of work. Even what goes unmentioned is oil and gas. We have a bit of oil and gas work as well, which is kind of some legacy opportunities. My background has been predominantly oil and gas years ago, so I have the contacts there. But it's great that went through kind of a lull period a few years ago. But right now we've seen a good uptick, and we have a handful of pumps doing some decommissioning work. So there's that upcoming work for clients to decommission, and then that kind of fits the environmental theme to help properly clean up after their work. And we're happy to step in and provide that equipment, because again, it's high horsepower, high flow, unique type stuff.
Yeah, and great to be able to dig into the Rolodex from your previous life as well on the oil and gas side. So that's good. So just changing gears to the maintenance segment, the question's been asked, is the demand that you've commented on in the rentals segment from the mid-tier gold players, are you also seeing that come through on the maintenance side of the business?
On the maintenance side, the demand's been with the bigger guys. It's the guys that you see the front page of the paper all the time, which has been great because I guess as we've matured as a business and as we've grown our capabilities and as we've had good quality rebuilt engines going out year after year, I think clients, the big guys, have that confidence to push more of that work our way, and that's great because they pay their bills. People complain about timing or whatnot, but there's low counterparty risk. We have big equipment. Big equipment is bigger engines, it's bigger dollars, and it's more profitable for us to do multiple, where we need to do 5 or 8 of the same type engine for a fleet of trucks or a handful of diggers at one time. So really, the maintenance side, the growth and the demand is really on the bigger end of town.
Yep, good to hear. We've had a few questions just on potential M&A activity, so I'll cobble a few of these together. One investor's asked, or he's commented, congrats on the result and executing the turnaround, albeit on a shoestring budget. Can you give us a feel for the characteristics of any potential acquisition, what it may look like, or what you're looking for in terms of location, new revenue lines, bulking up existing offerings, or or would it be sort of more of the same current business?
Um, Everything's taken on a case by case basis, and acquisitions in the past have been for multiple reasons. Where sometimes if it's a very small company, they may have a great management team, and we feel like, well, we're getting value there. We're buying an existing business. They have some good turnover there, but you've got some capable people that put in a bit larger structure of a listed company around them, a bit more capex, they can grow from there. But so we will look at all aspects of the business, but generally we want asset heavy in the water management, power generation, rental type space. So from a water management, that does cover a wide range. We want stuff that would be not your stock standard low barrier to entry, and then also not your there's a handful there's power generation companies out there that all have predominantly diesel generation, and you know what, we can go buy diesel generators if we want to. There's no use buying a large company for that or a medium-sized company for that. We feel like we could grow on our own with that. We want people who are going to have a bit of a differentiation. Were they trying to tie a little bit of a ESG theme into it with some hybrid power or whatnot? But again, we're looking for assets that are working, and we're looking at the quality of if we can bring some quality management in as well, because it's tough. It's tough to get the right people right now. The market's always tight, and getting good quality people is always hard. But if we can find people who have that entrepreneurial spirit, who have some other small businesses that come in to help grow us, that's really key for us as well.
Yeah, and so where would you like to set expectations as regards sort of number of potential acquisitions that might be in the pipeline, or are there too many moving parts to sort of be able to?
Yeah, I like to minimize all expectations if I could, but
Yep.
no, unfortunately, we will grow organically, and we will likely grow by acquisition as well. Now, we always have a range in mind that we're looking at, and there's big stuff and there's small stuff. It really it's a matter of what's going to make the best sense for us and for shareholders and for our continued growth. Small acquisitions, that's where we've kind of had our bread and butter the past couple of years. We're comfortable with that. We feel like we can do that with a mix of bank debt, kind of some deferred consideration, and not really going tapping shareholders and diluting shareholders for capital raisings. So I feel like there might be where we can package a couple of those together, going forward. And then there's also the larger opportunities that we have to consider. So pretty much, I guess I want to manage expectations and say it's all on the table, and we have a pretty capable and strong board to help me with these decision, this filtering type process. And as I talk about this, it doesn't mean something's going to happen next week. Doesn't mean that something's going to happen this year. But it also, my message is, it's something that we are actively and strongly considering, and there's a strong basis for us to filter through and make sure that we do it for the right reasons, and then we have the right the right story to bring to shareholders and to the market to say this is how we're going to grow, and it fits our theme: rental, unique, specialty, and with a bit maybe some ESG type thematic for it, because it's the long term way the world's going.
Yeah, excellent. And I think you partially answered this question, but as a follow-on from the others, regarding potential acquisitions, have you considered how you would fund it? I think your comment just then was smaller acquisitions would be potentially a hybrid of deferred consideration, existing cash, available debt, but is that sort of I guess, the general structure or playbook that would apply?
Yeah, it's a case by case basis, and we have we come across companies where you might have a vendor who just wants out, and just say, give me some cash and I'm gone type thing. Well, I mean, for me, when I've come across those in the back, that kind of sometimes raises some red flags. That's part of our filter process. So we are a small company. We have to work hard, and I think we've proven that we work hard to have creative ways to bring on the last two acquisitions and bed them down. And we did that, with while we've used these to grow the company. So I feel like that's great. But also we are ambitious. There might be larger opportunities out there that come across our desk, that sort of thing. So again, we're not saying no to anything. It is everything's under consideration, and just trying to convey our thought process of what's going to fit our criteria to go forward.
Sounds good. Just coming to our last couple of questions now. So any attendees with questions for Michael, please do pop them into the screen. Still on M&A, but I guess on the other side of the coin, if you're looking forward in 2 to 3 years, do you see any of your existing businesses being sold, becoming non-core relative to the overall mix of business and revenue?
It's a tough one, because as a listed company, everything's always for sale. That's just how it is, and we feel like, I guess if you had asked this question a couple of years ago as we were growing the maintenance business, I might have been pretty quick to say, well, you know what, that's hard work. It's a big constraint on management, takes a lot of management time, that sort of stuff. But lo and behold, we've had some good results, and it shows that hard work has paid off, and the work we've put into that maintenance business. Now it's grown, and it had the largest jump in EBITDA last year, so we're very happy with it. I need to do the same with the rental side and continue to grow that. But like I said, as a listed company, everything's always for sale. That's part of what we do. We have to consider anything and everything that comes our way. But at the moment, we're happy with the results from last year. We're happy with our growth plans for this year. And I guess, who knows? The phone rings tomorrow and things change, and it's just something we have to consider, what's going to be best for the long-term growth of the company and what's best for shareholders.
Yeah, lots of potential moving parts there. And so if you look into your crystal ball, one investor's asking where you would like to see the business in 2 years' time.
Obviously, we want to see more scale, higher turnover, higher earnings. We'd like to be to that critical mass. We always want to have high ambitions. I want to be careful I don't give, quote, numbers or forecast or whatnot, but we definitely want to grow and scale and grow in our financial return. With that, we want to stay in the resource sector in the next 2 years. We want to be critical, continue to be critical for our clients, and supply needed and critical services to them. So we need to make sure we focus on that and just further ingrain ourselves, because we feel like, the Australian economy, the resource sector, yes, you're going to have ups and downs. You're going to have different stuff that's going to make the newspaper every day, but it will continue to grow. We want to be a bigger part of that over the next 2 years, and make sure that we are, yeah, providing a valuable service and being fairly rewarded, and that value is recognized both by our clients, and that value is also recognized by the market to understand what we do is critical, and be able to understand how the fundamentals of the business.
Yeah, well, on that topic of recognition of your value by the market, the final question we've had come in here is asking the question potentially incredulously that are you really trading at under 4 times earnings? The comment's made that that's a private company multiple and you're an ASX listed company self-funding your growth.
Yeah, yeah. It's a tough time for everybody. I will invite. We've had some independent research be put out by PAC partners, and I think that has been distributed. I don't think it's posted to our website, but I'll make sure I get that posted to our website so everybody can see that. But it's just the state of the market. We're not alone. We're a small guy. We feel like that we are. As much as I'd like to win sometimes and say we're unfairly treated, we're fairly treated. I've got to get out there, and we have to perform, and we have to show everybody what we're doing. We feel like that we are doing that. It's just a matter of getting that recognition. And but again, we're not alone. Just the market, the resource market, the service sector for us, and the small caps. It's where we are. It's where we are. But I feel like there's a lot of value in us from here.
Plenty of upside. So
Yeah.
no, it's very timely that you've mentioned the research. So PAC Partners initiated just a couple of weeks ago on Babylon. So as Michael said, we'll get that up on the website. I'm pretty sure it's been posted to Babylon's LinkedIn page as well. So you get it there, or you can reach out and we can send that through. So
yeah, anybody can reach out to me. I think my contact information is readily available. I invite anyone with specific questions. I love talking about the company. So reach out to me. I'm happy to chat.
exactly, me too. Um, so yeah, on that note, we'll draw a line through it there. I'd love to thank everyone for tuning in. Really appreciate everyone's continued interest and support of Babylon. If you do have a question that we didn't get to today, please do reach out. Michael and or myself will be happy to discuss further offline, and we will also make the video recording of this session available online on the NWR YouTube channel and on Babylon's website. So yeah, really looking forward to the opportunity to chat to you all and see you all in person again soon. And Michael, I might pass back to you now for any closing comments.
No, I appreciate the help, Tim, and appreciate everybody's time. And like I said, happy to chat with anyone. And feel like it's an exciting time for us. We've turned a corner, and we have the ability to go onwards and upwards from here. So thank you.
Excellent. Thanks, Mike. Thanks, everyone. Chat to you again soon. Bye.
Right. Thank you.